To bring in Omar Aguilar. He's of Charles Schwab's Investment Management. And Omar, it's great to speak with you again. Looking at a record here for the Dow, we got that much better than expected retail sales number out before the bell this morning. How are you looking at this? And I guess, does this help that bullish thesis, that bullish sentiment that we've been talking about for so long out there on Wall Street?
Yes, thank you for having me. And well, the market seems to be behaving, more normally than what we all expect it to be, especially in a year after 2020. The cyclical rotation that started back in November continues to unfold, and it still has, some room to go. If you actually think about all the things that are lining up with a day like today, or even yesterday, when value outperforms growth and momentum underperforms, when you see risky assets being in high demand, you can actually see how that cyclical trend that is consistent with optimism about economic recovery continues its trend, from the day that, the vaccine was officially announced back in November, and we continue to see that trend. Now, what has happened is that this cyclical rotation continues to be, supported by obviously the stimulus program that puts, the consumer at the front end of what may come down the road, and therefore it's not surprising that you actually see higher yields in treasuries, and you actually see risky assets being in high demand. And when you combine that with the fact that commodity prices are also rising, you actually see that combination that gives us a little explanation of the action of today.
So, Omar, when you say to your clients, stay disciplined, avoid market timing, don't chase returns, don't chase yields, when's the appropriate time to rebalance? Is it when we are at a high point like we are now, or do you wait till the dip begins and then go to the rebalance?
Well, that's a great question, because, what we always stress to our clients is the fact that in order for you to look at your long-term objectives, a disciplined rebalance strategy needs to happen. And in periods like this, when things are relatively normal, this is the time where you just need to be consistent with your risk profile. You don't need to overact. You don't need to overtrade. You need to be consistent with your long-term objectives. Yes, the opportunities of rebalancing and repositioning usually comes when you actually see changes in the market. In this particular case, what we are discussing with our clients is that even though we continue to see that cyclical rotation I was referring to earlier, is, we're not at the end of the line. We still have risk in the horizon, and therefore, maintaining a healthy exposure to stability, which in this case tends to be more growth stocks or large cap names, tends to help in mitigating a lot of those periods of volatility. So having a disciplined strategy when you rebalance, whether it's on a quarterly basis, whether it's in a monthly basis, having an execution strategy that allows you to maintain your asset allocation is what we stress to the clients. Even though they may see, asset classes that run very high or asset classes that get depreciated, having a discipline around the times of rebalancing is usually what we recommend.
Omar, when you take a look at what's going on in the bond markets, we had the 10-year yield right around 1.3 right now, under a slight pressure today. But is there any risk, or do you think yields are rising too quickly at all? And I guess, what does that mean for equities?
Well, that's, the situation with the yields is kind of interesting. I actually do think that the speed of the changes in yields is what is surprising. We started the year at very low levels, and we have gone up to, 1.3 very quickly. And I think the reasons why this could happen is, one is there's a significant amount of optimism regarding to economic growth. And I think when you look at the trajectory of the 10-year yield and you compare it with the rollout of the vaccines and the number of positive cases going down, that seems to be a very high levels of correlation. As the expectations for the bond market is that the economy will get better in the second part of the year, and it's confirmed in a day like today when you have retail sales and the prospect for consumers to basically go out and finally start spending. So when you actually think of the main reasons why those things are happening, they're positive, which means expectations about future economic growth out there. I think to answer your question about the risk, has to do with inflation. Inflation expectations are also rising, and therefore the potential for having a spike in prices and a spike in rotations, a lot of that is temporary because of the commodity prices and oil and the weather that we're going through right now. But the question becomes, whether the inflation expectations match with the actual price increases, and therefore that will actually put pressure of future growth. And as such, it will actually put pressure on global central banks. That's really the risk that we run when you see these pieces. We don't think at the moment the actual inflation is of risk, at least the short-term inflation. However, as we continue down the road and depending how we reopen the economy, it's something for us to continue to watch.
Omar Aguilar, always great to speak with you of Charles Schwab Investment Management. We'll talk to you again soon.